Hey, Bulls and Bears, welcome back to the channel. We've got a big update for you today. It's an eye opener. Discover DFS, Discover Financial Services, the company that puts out the credit card, Discover card that most of you are probably familiar with. Well, they came out with a warning today about impending charge-offs. And anyone that's been on this channel, you are not surprised. It was just a matter of time, right? Folks are running up debt like never before. Record levels of debt in all categories. We're approaching $1 trillion in credit card debt as consumers, as a U.S. people. We're seeing more and more people use their credit card as a lifeline, buying necessities like groceries, paying utilities on their credit card. Each month, more and more people not paying their card off in full, and that's going to equal more charge-offs. All right, so let's talk about what Discover Card put out there today, and it actually scared the entire financial sector. Well, mostly the credit card companies. We're going to talk about that here in just a few minutes. For those of you newer to the channel, not aware of the dire situation that most consumers are in, a combination of high cost of living, people putting their necessities on credit cards, the inflation, the overall state of the U.S. economy, the low wages versus the high cost of living. Going back many decades, all the jobs that have been outsourced, causing a lot of the high-paying jobs to leave the country, has us in a very precarious situation here with so many consumers now in so far in debt and so far underwater. They're not going to be able to survive much longer. And we're going to talk about what the implications are going to be here. But first, let's take a look at what Discover Card put out there. And we'll just look at this headline out of Bloomberg. Discover drops after warning about rising credit card losses. Folks, this was inevitable, right? Unavoidable. No surprise to anyone that's been on this channel, but yet it's shocking news throughout the financial sector. Consumers are having a hard time paying their credit card, and now there's going to be a lot more charge-offs this year. Charge-offs meaning the credit card companies are just going to have to write off these debts as bad debts or as bad loans. And the next thing that's going to happen, I think, this year in 2023, as I've mentioned many times, we're going to see a tsunami of bankruptcy filings throughout the consumer sector. And here it is again, folks. Do you remember this chart from a few weeks ago? Well, this is a chart we've been watching for years, but it's only recently that we see this big spike here. This is the average credit card interest rate. And ask yourself, with the current debt levels, how long can people stay solvent with this big of a rise in credit card interest rates? And even if you look back at the 2006, 7, 8, 9 year, 2006 through 2009, the financial crisis era, we see that the average rate was only around 13.5%, 14%. So now we're in much of a worse situation, most consumers anyway, not everybody. Some people now are still doing just fine, better than ever, paying off their card in full each month, or actually not even having to use a credit card in some cases. Even people that are out of debt still sometimes will use their credit card just to rack up those credit card points or the airline miles, whatever it is you, what kind of perk you get out of your card. So there's still a few people out there, but it's a very small portion of the population that's in that position to pay off their card in full each month or not have to use their credit card, one or the other. Most people having to use a credit card more and more now just to survive. And on top of that, more and more now not paying off their balance in full each month because of the rising cost of living, the high cost of living, and now these rising rates. Altogether, that equals danger for the U.S. consumer. And let's take a look and see how the credit card companies' stocks performed. Well, if we look back here to August 2022, we're looking at about 6 months here. We see that all of them are down, including Discover Card, which had the news today, down about 10% since then. Capital One down over 16%. We've got the Synchronicity down 5%. And the pain continues in the financial sector in these stocks. And I wouldn't want to be holding any of these stocks right now unless you're getting a really, really nice dividend out of them. I see a lot of downside with these credit card stocks, because what's going to happen next? Well, credit card companies are going to be forced to start cutting lines of credit, cutting off or lowering the credit limit on these consumer cards. And folks, let's think about how bad this can get. We have so many people now dependent on credit cards just to pay necessities, right? Utilities, groceries. And now the credit card companies are going to be forced to drop many people's lines of credit, and more people now that think they have some additional credit to run up, well, they're going to be in for a rude awakening. And it's not a funny thing if you're one of those families that's having to live off credit cards and you see your credit limit get dropped. Maybe you can't put that next utility bill on the credit card. Maybe you can't put that next grocery shopping trip on the credit card. And if you don't have the money available in your bank, what are you going to do? Starting last year, we already saw a big uptick in people pulling money out of their 401ks. So maybe more people will have to do that as another lifeline. But see, all these things are just temporary, right? Not nobody has an unlimited amount of 401k they can pull out. No one has an unlimited credit ceiling. Well, the U.S. government, the U.S. government, they can continue to raise their debt ceiling, but U.S. consumers, not so lucky. And it's going to be a lot of pain throughout, I think, millions of households here in 2023. DSF, Discover Financial Services, came out and is forecasting now a charge-off amount of nearly 4%. Now, that may not seem like a lot, but in all of 2022, it was under 2%. So this is a more than doubling charge-offs. So not a good sign at all for the state of the U.S. consumer. Not a good sign for these companies. And if you're in one of these stocks, you may want to take this news into consideration with what might be ahead for the performance of your stock. Now, it's interesting. A lot of people looked at this type of news as a positive for credit card companies. The logic behind it is that more people are going to have to use their credit card just to survive. So that's good for the credit card companies, right? More fees they could charge. They get charged. They could charge a fee for every swipe. More interest that the customers are going to have to pay because the rates are rising and their balances are also rising at the same time. But when the consumer reaches the end of their financial rope, so to speak, that's going to equal more charge-offs to the credit card company. And we're already seeing it in these stocks performance with all these companies, as we showed you in that chart just a few minutes ago. All right, let's move along here, folks. In other news today, we've got more debt ceiling drama. Now, this is likely a nothing burger, but here's what is happening and what is likely to happen even on a bigger scale here. They're cutting back on certain things here. They're tapping retirement funds to avoid breaching the U.S. debt limit. And we've seen this happen at least a dozen times before, where they reach the cutoff time and then they have negotiations and ultimately they reach an agreement. But sometimes there's a partial shutdown of the government, and we may see that this time. And what do they typically do? They typically shut down parks and what they're called extraordinary measures. And what they're saying is they have to cut back in these areas with these extraordinary measures to avoid a default. Now, some people say, well, they should just be allowed to raise the debt ceiling without any negotiations because ultimately they're going to end up raising it anyway. So why even have the drama? Why even have the debate? Just continually raise it without any question, without any debate. That's what some people say, that they should have just unlimited debt raising capabilities or debt ceiling raising capabilities. Other people say, hey, myself and households, we don't have unlimited debt. We can't just raise our debt ceiling here, unlimited amounts. Just like we talked about the credit card defaults earlier, people are likely going to see now their credit card limits lowered and their so-called debt ceiling on the credit card is going to be lowered. So why can the United States as a country just continually go into endless amounts of debt with a continually raised debt ceiling, right? So pretty crazy. Could something happen where we've never seen before, where the shutdown lasts for an extended period of time? It's possible. I don't think that's going to happen, but prepare for anything. And who knows what they're going to shut down and pull back on? Are they going to pull back on payouts for Social Security and other programs? And just one example of some of the extraordinary measures that are being discussed is pulling back on investing in retirement accounts for certain federal employees. And many of you may remember a government shutdown from a few years ago where even federal employees were having a hard time after only missing one or two paychecks. We saw certain people within government putting out what's that called, GoFundMe accounts, because they couldn't pay their bills, because even a lot of the lawmakers here are living paycheck to paycheck. So of course, them not passing the increased debt ceiling comes back to hurt them a little bit, and that's why one of the reasons why you usually see the debt ceiling get continually increased. All right, let's move on, folks. Let's talk about this. And again, if you've been on this channel, you probably knew this was coming. More protections are being discussed. We see certain states and certain cities have extended the eviction protections for tenants not paying their rent. Some of those states have let them expire. Other times, states let it expire, but there's certain cities that still have protections in place. And some of them still have it in place even now, not only, but almost 3 years since the onset of the health crisis there in 2020. We now have the White House preparing new tenant protections, which is, quote, alarming the housing industry. And we've always said here that without additional protections being put in place, without new programs coming out like this, that there's going to be a tsunami, a wave of homeless. We looked at Los Angeles a few weeks ago. They're still kicking the can down the road. It was going to expire at the end of January. Now they're talking about extending it another 6 months because there's so many people that are going to be newly homeless. And if you know LA, there's already tents on so many of the streets up in LA. They can't afford to have a surge of maybe thousands, tens of thousands of more homeless people, people getting evicted. They can't afford that. Or I should say, they don't want to have that happen to their city because it already looks bad when you see all the tents on so many of the cities in the downtown area. And if you saw my previous report, you know that even San Diego now has many blocks here downtown that are lined with tents on the street. Parts of San Diego are beginning to look like the worst parts of Los Angeles, with all the tents lining the streets and all the homeless people. So folks, this is an ongoing disaster. There's going to need to be more programs like this, and I think they'll likely pass something on a national level where it comes, right out of DC, that there's going to be this maybe nationwide eviction moratorium. We'll have to see. Right now, it's just being looked at. But the fact that it's even being discussed and talked about should really tell us, the real state of the U.S. economy and the real state of the U.S. Consumer. Now, if we take a look at the stock market, we see that Wall Street is finally starting to price in some of the bad news that's coming down the line here. And this is a 1-year chart here. We're just going to look at the Dow Jones. And I've always said here that I don't think we're going to breach the highs that we witnessed in the stock market previously. I said it's going to be a downtrend, that we likely wouldn't see higher highs, that it was going to be lower lows going forward. So let's take a look here and see what's going on so far. So let's take a look at what's been happening now in the markets here. And we see the highs here from the beginning of 2022. So we're going back on a 1-year chart here. And we saw the next big rise was last summer. Didn't reach that previous high. And we see the last two here, where each one ended up being a lower low. And I think it's downhill from here. How much longer can the stock market ignore what's happening amongst the economy? And the economy is the U.S. consumer. Why do we say that? Well, the U.S. economy is based on consumer spending, consumption. We are a debt-based economy. We are a consumer swiping their credit card based economy. That's where most of this economic growth comes from, is people swiping their cards and taking on bigger and bigger amounts of debt. And when things happen where, like we're seeing now, people get closer to their debt limit, credit card companies start bigger charge-offs, and the economy, it's all downhill from there. So folks, there you have it. Economic reality is really starting to set in. It's not just me sounding the alarm anymore. It's Discover out there warning about these charge-offs. And folks, just the tip of the iceberg here. So I hope everyone's doing well. Keep preparing, keep stacking for what's headed to us down the road here, what's headed towards us, I should say. Thanks everybody for being here for this report. Hope to talk to everyone very soon. Bye for now. Keep stacking. Big love and peace.